Makwe from Makwe Fund Managers joining us to unpack those numbers. Makwe, very good evening to you as always. Let's start with the overall market performance today. The JSE really gaining some momentum after a little bit of a rough start yesterday. And I suppose there are improvements with the global growth outlook from the IMF, and that's despite China's economy losing steam. So that's largely the global picture. But what would you say were some of the other drivers for the positivity that we saw on the market today?
I think the fact that China have pledged to make that they will make sure that they come with policies to try to prop up the economy, that helped. Hence, we've seen our mining stocks doing that great. And I think as well, market participants have started to dial back their forecast when it comes to recession. Market participants start to think that we will probably have more of a soft landing. And remember, when interest rates are low, dividend-paying stocks get to be attractive. But when interest rates start going up, the yields going up, then people go back and try to chase the yield. But now people are betting that come tomorrow, the U.S. Fed will probably, after raising interest rates by 25 basis points, they will pause going forward. So those dividend-paying stocks are becoming appealing again.
Yeah, and that, of course, having an impact on the strength of the local currency, Makwe. 17 Rand 60. When last did you see that kind of number? I suppose it's not purely a dollar story, but a lot of it has got to do with what we're seeing coming out of the United States.
Definitely, and bearing in mind that the rand itself is a commodity currency. As we said, we've seen commodity prices going up, and that's at the back of the Chinese economy will probably do better. So far, we've been seeing some uneven recovery coming from that side. So with them pledging to come with policies, then we expect that there will be demand when it comes to commodities. So that as well is benefiting the rand. You can easily say that it's more of a risk on trade more than anything.
Yeah, let's get into some company updates. We start with a favorite on the market, Makwe, ShopRite. Always one that beats the odds. Retailers like Pick n Pay and so have seen a lot of challenges, but for some reason, ShopRite's market is an absolute sweet spot that continues to give ShopRite the returns that it's been getting. What did you make of the update that we got from them today, and obviously what they're expecting to see in revenue when the results are released?
I think they've got a nice exposure when it comes to middle to lower LSM, and we know those are the people who spend more than 60% of their disposable income on food, hence they continue to do well. Look at the likes of ShopRite and USAfe, sales up nicely, over 15%, but also they continue to eat the lunch of the likes of Woolworths, because also on the higher LSM, that's starting to do great. You look at Checkers and Checkers Hyper, sales up almost 8%. So the guys are doing just great. But yes, unfortunately, load shedding, the guys had to spend almost 1.3 billion. And remember, Pick n Pay for 4 months, they spent almost 300 million. And the guys also opened 340 new stores. So that's sitting at 3,328 or so stores compared to the likes of Pick n Pay, which has got plus minus 1,628 stores. And the internal selling inflation, not too bad, at 10.1%. We know that one of Pick n Pay was almost 9.45% for 4 months, but that's still below the CPI inflation for food as it's released by Stats SA. So market share gains also working for them. And remember, they also had huge discounts that also worked to their advantage by giving consumers those discounts.
And of course, they did see a 30% increase in liquor sales, Makwe, a healthy market for South Africa, as big drinkers, South Africans are. I mean, it does come off a low base, but good growth nonetheless. Kumba, an opposite story for them. They had really released a profit warning indicating that the picture doesn't look too great. There's logistical issues, there's load shedding, but also the demand for commodities is not as great as it was in a previous cycle. Your thoughts on those numbers, those interim numbers?
And because of those logistical issues, the guys had to put aside almost 2 billion when it comes to non-core capital expenditure. And we know because China economy has not been doing that great, so there's not been demand when it comes to steel and all gets to be used, when it comes to steel making. And also outside China, the global economy was not that great, but prices were at least helped by the fact that if you look at the stocks at the mills at China, they're almost at a 5-year low. So there's almost a tight balance when it comes to supply. Production up only 6%, revenue down 11%, profits as headline earnings per share share down 17%. So it was not surprising to see their dividend per share falling by almost 21%.
Cash build, this was a good indicator of the health of a consumer at some point. And as we're seeing, as consumers struggle, so does cash build, in the operational update indicating that revenue was lower or will be lower. And the picture doesn't look too great for cash build. What do you make of what they had to share with us today? I mean, just 2 years ago, they were having a really good time with people being at home and fixing up their homes and offices and so. And now the tide seems to have changed for them, and not for the better, unfortunately.
Unfortunately, you can only do so much when it comes to improving your home. And when you are done, you are done. There's nothing much you can do. So it's not surprising to see their revenue down almost 4% and the transactions through the tills down almost 3%. But their selling inflation is not too bad at almost 5.4%. But yes, you are right. They've just had their days during lockdown because all that money that we could have used for other things, we just used to improve our work or study from home environment. But as it is now, people don't have a reason to do that. People are starting to eat out because we no longer have lockdown restrictions. People are traveling, but yes, it's not too bad for them going forward. But unfortunately, we are comparing this from a very high base.
We are indeed. Ellie's, Makwe, they, for those of the who don't know, I think they were also the ones that install your satellite dishes when you got DSTV. And so diversified now, they are inverters and they're focusing, investing heavily on the power space. They're releasing an operational update. The picture not looking too great, but they are hopeful because of the power investment that they're making. Your thoughts on that update and really the direction that they're going in when it comes to that investment?
Not looking okay for them. We've seen their headline loss per share increased by almost 63%. And we know, as you said, because of the satellite installation declines. But remember also retail side, consumers are under huge stress. But it's seen a nice uptick when it comes to solar, generators, backup powers, but unfortunately, they couldn't take or maximize that opportunity because of lack of working capital. So as soon as they sort that out, then probably they'll be able to take advantage of that kind of an opportunity where they've seen a nice demand.
Absolutely a wonderful conversation between you and I this evening, Makwe. Thank you very much for your time. That is Makwe Masilela from Makwe Fund Managers joining us to wrap up the market day that was. And that's all from